Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up as part of one of my blog posts for you to take a look at. Now, if you're not on my free email list, you didn't get that email and you need to get on it. So look below this video at the link to join, and then you'll start to get my stock trading updates. And typically there's one every single trading day before the opening bell. Now, this video, I kind of hesitate to do it because once posted on YouTube, the comments I'm about to make and it will cause people to immediately drop off the video or hit the dislike button, because what people want are stock picks or crypto coin talk. They want to hear if they buy a coin, the coin can make them rich beyond their wildest dreams, or a call option. They want hype. And even on television, that's what they get. That's the whole premise of fast money. Here's a trade, here's a trade, here's a trade. But there are times in the markets when it's best not to trade because there's not that many great profit-making opportunities. That typically happens when you're in a churning market in which you've had this 45-degree upward momentum sort of stall out. Doesn't mean the stock market's about to crash, but you're in a breather time where the market's resting or having a bit of a pullback, a digestion of recent gains. At least in a bull market trend, that's what happens. These pauses happen all the time. But if you look at long-term charts going back decades, you will find that the move that we had last year that lasted up until February when it comes to the NASDAQ, in most fad stocks that were shooting up, and then peak in February. So in fact, that's what Bitcoin itself did. Those type of straight up moves, if you look at a 100-year chart or 100 of the Dow or something, they are not what is going on most of the time. Most of the time, the market averages are trading more sideways. The typical gain is less than 10% a year, not what you saw last year from the low. So all that said, there's indicators in the market that that are telling us, if we pay attention to them, that this is the sort of market environment we're in. Specifically, we are seeing internal indicators dip in the market, and they've been doing this since early June. These indicators can warn that you're in a bear market or a topping phase, but the way the indicators are positioned now, they do not indicate that we're about to crash at all. And I have to show you the indicators in past examples so you'll understand that. So let me share you my screen, and what you're seeing here is the cumulative volume for the S&P 500. This indicator is generated by taking a look at all the buy volume in the S&P 500 stocks and tallying it up day by day, subtracting with the selling volume. So it's a simple way to show us that when this volume is going up, there's more buying than selling overall inside the S&P 500. Well, this indicator peaked in June. And even though the indicator peaked in June, the S&P 500 itself made a new high recently, 2 weeks ago. It went up after this indicator peak. So how did that happen? Well, that's important to understand, because what happened was the leadership inside the S&P 500 really shifted into less than 10, really 5 big cap technology stocks, which heavily weight the S&P 500. So those stocks going up themselves were able to help lift the market averages up, despite the fact that overall, when it comes to the totality of the stocks inside the S&P 500, there's more selling than buying. So it's a classic sign of narrowing leadership, which technical analysis books will tell you that's a sign that you're nearing the end of a rally. Well, we have seen a loss of momentum when it comes to much the stock market. This is why the Russell 2000 as peaked in June, just as this cumulative volume peak, and tested its 200-day moving average. It's well off its high, despite the fact the S&P 500 is on it. You just made a new high 2 weeks ago. That's because this is not heavily weighted by Facebook, Amazon, Google, Microsoft, and so and those stocks. Far from it. It's 2,000 stocks that are in this, and they're not the giant caps weighing it. But another sign of internal weakness is this. This is the number of stocks inside the S&P 500 above their 200-day moving averages. This indicator peaked out in May and has not been making a new high at all. In fact, it is broken down. Despite the fact that S&P 500 made a new high 2 weeks ago, this indicator went below its July high. In fact, even below its March high. So this is a sign that there is a lot of stocks in the stock market actually acting weakening despite the rise in the market. Again, it confirms what you're seeing with the overall sideways trend, let's say, in the cumulative volume for the S&P 500 indicator. Now, as I said, though, these negative divergences are a classic sign of, at least a market that's running out of steam, potentially making a top or going into a bear market. However, this is a big point, that process of this weakening of these indicators can go on for months before a market goes into a bear market. And that's even if that happens. It could, this process could continue, and then the indicators turn up later in the year. But it's definitely a sign that at the moment, this is a much more difficult environment to trade in. And this is showing you why. When there are more stocks really going down than up, and more volume selling than buying, that makes it difficult, for the most part, a much more difficult trading environment than what you've seen before. Now, let me show you two examples from the past, though, that will help illuminate to you why this does not mean we're in, heading for a stock market crash. So in 2015, the S&P 500, which is the black line on the bottom of this chart, it did have a steep drop in August, rallied back up, and then fell again in the first quarter of 2016. It represented a 20% decline from the peak of July 2015 to the low of 2016. There's 20% decline. We saw a similar 20% decline in 2018, in fact, and of course, 2020, there was a crash situation. But what I want you to take note of here is, again, so 200-day percent of stocks above the 200-day moving average is the indicator on the top. That indicator did peak out really in October of 2017. So it took 10 months before the market really dropped, while this indicator created a negative divergence against the stock market. And this indicator sharply began to trend down in May of 2015, and the stock market actually made a new high in July. And the indicator was much lower than it is now. It got down to below 50%, and then in July 2015, and then the Nasdaq made a new high. The S&P tested its high in May, and this indicator barely went up. So the negative divergence really became incredibly pronounced. It was a massive warning sign, but the divergence is nowhere as strong now as it was then, and it took months and months and months for it to get that bad. So it's at 77%, not anywhere close to 50, not below 60 right now. And it really takes a divergence that big to make a huge warning that, look, you're at a 20% decline, high risk point, or even a bear market. No, we're not. The indicator is not that bad. The divergences are not that bad. The advanced decline line is not that bad. It is weakening. That's why it's harder to trade now. It's why in some ways it's best to take a breather, not to overtrade, and let things kind of come to you. That's what I'm doing for the most part in these markets. But another example is what happened when there was a bull market top in 2017. This indicator, the percentage of stocks above the 200-day moving average, topped out around March 2006. and the NASDAQ made its final high in October of 2007. So, and this indicator really fell for 7 months, let's say, and created a very pronounced divergence in August of 2007. The indicator went below 35%. So less than 35% of stocks are below 2-day moving average inside the S&P 500. And there was a rally back up to new highs after that divergence happened, and the indicator, got up to about 60. So, a topping process in the stock market takes months to play out. And I can't say, the situation is the same. It could be that we're in a topping process, but if so, it really hasn't even begun. So, the indicators are a warning sign. They do suggest that, a top could come. It's no certainty. And we're in a sideways market. And I think that's the best way to understand it. But that environment, makes it so that a lot of stocks are now not trading well. This is why things such as the BUZZ ETF, the ARKK ETF are no longer doing well, relatively speaking, to the market averages at all. And many stocks that make up the top 100 list in Robinhood no longer are doing well either, even though a year ago you could look at that list and they were doing much better. So a lot of the fad momentum is slowly, it's like a balloon, becoming deflated, risk off sort of too. And you can see signs of that. There's been a correction in oil, commodities market as a whole has been going sideways for several months after a tremendous run up from the spring of last year. So, it's summer doldrums. And this happens a lot where traders, take a vacation in the summer, volume dissipates in the market. And there's stories that suggest that, or Robinhood has reported that its trading volume among its customers is lower now than it was months ago. So we're in a doldrums time in the market. And I think that's one thing you have to keep in your mind as you see the daily news items and the daily price gyrations in this coming week. So I think this now is the most important factor when it comes to the United States stock market. That's why I'm talking about it in this video, even though I know this type of talk turns people off, does not excite people, where they want to be told there's a great pick, or trade out there, when really it's time to step back, in my view. And, you have to focus on the best sectors in the market. In one sector still doing great, that I still own many stocks in, is the real estate sector. This sector is barely pulled back at all. And that's what you want to see in times of market weakness. Sectors that do not pull back tend to lead later on. So, real estate, there's no reason to think interest rates are going up anytime soon, or mortgage rates are going up anytime soon. So it's an interesting sector indeed. So I want to just go over these internal indicators, what they kind of mean overall for you. And it's something to keep an eye on, and we will keep an eye on them together, because they could give a much dire, they could be lined up in a situation similar to 2015 or 2007 or 2018, but they're not. But but if they do, we have to keep our eye on them now in case they do later. We have to keep our eye on many things in the markets, and that's what we can do together. So subscribe to my free email list if you're not already on it. If you are watching this on YouTube, and if you've not done so yet, click the subscribe button and then the bell next to it, and YouTube will send you a notification the next time I do a video update, because you need to get all my future video updates. And all that said, have a good trading week, and I'll be talking with you later.